Welcome to this explainer. Today, we're diving straight into the Royal Government of Bhutan's Ministry of Finance's latest macroeconomic update, cutting right to the numbers that actually matter. We're going to unpack exactly what happened in the fourth quarter update for fiscal year 25-26, look ahead at the near-term FY 26-27 outlook, and see exactly what's driving the nation's economic engines right now.
Here is our roadmap for today. We'll start with the concrete data on Q4's economic performance. Then, we'll check out the outlook for hydropower and tourism, followed by inflation and jobs, and then trade and reserves. Finally, we'll wrap up by stress testing all these projections against some looming macroeconomic risks. Let's get into it.
All right, Section 1, Q4 Economic Performance Update, analyzing the delta between Q3 and Q4.
To establish our baseline, we really need to contrast the Q4 hard data directly with the previous quarter. And what's absolutely fascinating here is the sheer delta across these core metrics. Just look at the top line. As the monsoon cycle picks up, we get this massive seasonal leap in hydropower generation. It nearly tripled in output, jumping from just over 1,400 gigawatts hours in Q3 to over 3,800 in Q4. But right below that, we're also seeing a sharp uptake in headline inflation, going from 5.64% up to 7.26%. The data shows this is primarily driven by global fuel shocks pushing up transport costs.
But you know what's wild? The tourism sector completely crushed it. It brilliantly illustrates the resilience of Bhutan's tourism, blowing past Q3 projections by an astonishing 56%. And what makes this so remarkable is that they pulled this off despite a generally subdued global outlook, thanks to conflicts in the Middle East causing longer travel times and flight reroutes for international visitors.
So how exactly did Bhutan manage to beat those projections by so much? Well, it all comes down to regional tourists. This boom was largely absorbed by a massive 65% surge in Indian tourists compared to the same quarter last year. They effectively stepped right in and filled the gap where international, long-haul markets softened. In fact, arrivals from countries other than India actually dropped by 3%, making regional tourism the undisputed hero of Q4.
Moving on to Section 2, Outlook, Hydropower and Tourism. Let's project the immediate future for these two sectors.
Let's talk energy forecast. Hydropower is, of course, highly cyclical, and as we hit the peak season in Q1 of fiscal year 26-27, we are expecting a massive jump. We're moving from Q4's reality of nearly 3,900 gigawatt hours to a projected peak production of over 7,600 gigawatt hours. For a country heavily reliant on clean energy exports, this surge is literally the bedrock that pays for domestic growth.
As for tourism, the medium-term outlook is looking pretty strong. This growth is heavily bolstered by much better regional air connectivity, like the restored Bangkok routes through Guwahati and those extra weekly flights to Singapore. But the report is very clear. High airfares and geopolitical tensions disrupting travel routes remain a distinct headwind for those lucrative long-haul markets.
Section 3, Outlook, Inflation and Jobs. Let's chart the pressure on the ground.
With those economic engines humming, we really need to look at everyday prices. Remember that 7.26% inflation figure from Q4? Well, looking ahead, we project that elevated pressure to continue hovering right around 7% into Q1 of the new fiscal year. The report points out that the near-term inflation outlook is highly dependent on domestic fuel prices and how they pass through to the broader economy.
But hey, there's a real silver lining here. Even with price pressures squeezing household purchasing power, the labor market has shown incredible resilience. Data from the Bhutan Labor Market Information System shows the economy added over 3,600 jobs in just the first half of the year. That reflects some very strong labor demand across the active sectors of the economy.
Pivoting to Section 4, Outlook, Trade and Reserves. Let's examine the widening deficit and the reserve trajectory.
Zooming out to the broader macroeconomic picture, we're seeing a widening current account deficit. It's expected to hit 23.4% of GDP for fiscal year 26-27. So what's driving this? It's kind of a double whammy. A slightly weakening export performance, specifically in key industrial materials like ferrosilicon, paired with much higher import demands to feed growing consumption and energy-related investments.
And naturally, this widening deficit directly impacts our foreign reserves. Now, Bhutan hit a healthy high of over $1.2 billion in reserves in June 2026, which actually beat projections. But the expected import cycle is going to draw that down. We're forecasting a step down to $1.16 billion in FY 26-27 and eventually to $945 million by FY 28-29.
But don't panic. It's super important to note that despite this drawdown, reserves are projected to remain well above the critical period threshold of $46 million throughout this entire forecast period.
Finally, Section 5, Looming Macroeconomic Risks. It's time to stress test these projections. We've seen the baseline, but the report highlights two major storm clouds we need to track. First, the ongoing conflicts in West Asia. While Bhutan's direct exposure is low, the indirect threat to imported fuel costs, transport inflation, and global tourism routes is very high. Second, we have major climate vulnerability. A potential super El Niño and a positive Indian dipole, which is basically a severe swing in ocean temperatures that messes with monsoon rainfall, pose massive, direct threats to Bhutan's core hydropower infrastructure. And as we saw earlier, that's the engine of the entire economy.
Which brings us to the big question we have to ask the data. If these tail risks actually materialize, say a renewed disruption to oil supply through the Strait of Hormuz, what is the worst-case scenario here?
Well, under the ministry's severe stress testing scenarios, a prolonged imported cost shock driven by those global conflicts wouldn't necessarily grind domestic production to a halt, but it would definitely compress business margins and household purchasing power. The data suggests this kind of shock could shave off anywhere from 0.26 to 0.53 percentage points from the economic growth baseline.
And that leaves us with one final thought to chew on today. As the country's infrastructure investment cycle inevitably drives up imports and draws down those reserves, can the twin economic engines of hydropower and regional tourism outrun the friction of global, imported inflation? It is a high-stakes balancing act for FY27 for sure, and one we will be watching very closely. Thank you so much for joining me for this explainer.